And Senator Chitney, you're the sponsor, right? You want to say a couple words about this, and then Abby, you can. That was probably the more comfortable seat.
I'll just say really quickly that Chris Pearson at the end of the last session with his, I don't know if you remember that, it was right in like the last day or two, just gave a really intelligent and thoughtful discussion about this. And he strongly was advocating for it. I loved how he said, he's not usually one to advocate for tax relief for businesses, but in this case, Chris Pearson was very strongly in support of it. And that's when I did some more digging, and it just seemed to make a lot of sense. And so I understand that last session it wasn't quite ready for prime time, but it seems like since then.
It got worked up as economic development took it up and ran with it. And I think the tax department then put some time into fleshing it out when it came here. And there were all kinds of tax proposals last year from the governor. It was, well, yeah, we can do this, but they hadn't really put any flesh on those bones. So
I remember the tax commissioner indicated that they would work on it on something they believed that it was workable, but they just needed to polish it.
Yeah. So I think it's been polished. This would help business owners that own pass-throughs. It would not help. I don't believe the wage earners that are also being taxed on their state and local tax. But it would hit a portion. And maybe Abby, maybe it'll get warm in here. It's chilly in this building.
68.
It's 68.
68.
It's warm.
And maybe it's because it was near my cold soda can.
It's comfortable. It's nice.
It has its moments. The halls feel chilly.
Madam Chair, for the record, Abby Shepherd, Office of Legislative Counsel. I do have, under my name on the committee's webpage, there is the bill language S45 as well as a presentation. And I thought it would make sense to start with the presentation first to lay the stage, since this is a slightly complicated discussion. But
That much we got from last year, that it was a slightly complicated worker.
it just has several steps to get to this bill. So just want to find the right page to share with you.
Okay, so it's the second thing under here.
Yes, so there's the bill, both the bill language, which I will go over after walking through this. Make sure. Okay. Okay, so this, the background on this is starting with federal law. So we're talking about income tax. And within the federal law, there is a state and local tax deduction, which is referred to as SALT. And there's also now currently a cap. So under federal law, and I feel like I've given these same sites to you several times now, so I apologize. But whenever we're talking about income, we always start from sort of the biggest bucket possible. So when you're talking about personal income tax, you start with gross income. That's all income from whatever source derived. That's the general rule. Taxable income is gross income minus either the standard deduction or itemized deductions, as well as adjustments to income. Within, there's a long list of itemized deductions. So we're not talking about standard deductions here, we're talking about itemized deductions. One of the itemized deductions under federal law is for taxes paid to state and local, as well as foreign government. At issue here is state and local, and that includes personal and real property taxes. It also includes general sales taxes, and I've noted there that's an either or. You can't take both income and property as well as state. So it's either income or sales. But what's at issue here is the deduction for state and local income taxes. As I noted there, it's referred to as SALT.
Income and the SALT
deduction.
deduction.
Yes,
Okay.
there's a list. That's right from the statute in section 164. So that is the general rule. However, the Tax Cuts and Jobs Act made it slightly more complicated. at the very end of 2017, starting in tax year 2018, and only until the end of 2025, the Tax Cuts and Jobs Act imposed a cap. And that is a $10,000 cap on the aggregate amount of taxes deducted for the tax year, and it's smaller for individuals who file married separately. And it applies to those 3 tax types. So that includes real and personal property tax, as well as income taxes and state taxes. So this is for individuals who are filing personal income tax at the federal level. If their state and local tax liability is greater than $10,000, they can only claim $10,000. So it's up to $10,000. I noted here in 2021, this did not pass in the Build Back Better bill federally, but there have been multiple. This is just one example of federal legislative proposals to either repeal the deduction or cap it at a higher amount, but those have not succeeded at the federal level.
But this is because the same bill raised the standard deduction.
There are
fewer itemizing because your average probably wage earner, middle class wage earner falls under that standard deduction. So this would probably be higher income people that would owe more than $10,000. I mean, $10,000 in property tax in the city of Montpelier, not hard to do.
But yes, this is an itemized deduction, so it is in lieu of the standard deduction, and part of the Tax Cuts and Jobs Act was repealing or suspending. They're still there. They will come back after 2025. They will be operative again, but both the standard deduction, I think, is doubled, but the personal exemptions were suspended.
So if I have to do all the itemized deductions, and I've got I'm going to have to figure out the complications of doing all of that worth what I'm going to get for, okay.
So that includes other itemized deductions. It's, this isn't the only one that individuals look at, but that's also, for example, the mortgage interest deduction. That's an itemized deduction that can be significant enough that taxpayers choose that because it's more beneficial than taking the standard
If you're
deduction.
paying present mortgage rates. Probably is.
So, moving on to Vermont and how Vermont responded. I actually went back a year in time because Vermont had already changed its taxable income definition to adjusted gross income. Previously, it was federal taxable income. So that was just 1 year before the Tax Cuts and Jobs Act took effect. So that means that now, currently, the SALT deduction does not directly flow through to Vermont taxpayers. It impacts them when they're filing federally, but those itemized deductions are not in Vermont statute. That is, as has been discussed in this committee already, that is why there are there's one main itemized deduction that has been enacted into Vermont statute, the medical deduction. There are also other, because Vermont
The
responded.
medical deduction is very
You want to go down that wormhole, but
Some of
there,
us in this committee fought for something a little more liberal, but we lost.
but just to really highlight that this is a federal deduction that's happening after Vermont is pulling from federal adjusted gross income. So really, this is a federal tax definition that does impact Vermonters, but it does not change their Vermont tax liability. So there were several different creative proposals to try to get around the $10,000 cap that other states proposed. One was creating a charitable contribution credit. There were a few other versions of ways to allow for a tax credit that would be equal to what individuals are paying for taxes, so that it would lessen their federal tax burden. Those were not found to be those were disallowed by the IRS, by the Treasury Department. However, there was one, which is what this bill S45 gets to, that was considered an allowable form to enable individual taxpayers to take a full deduction. So I've included here just a quick brief reminder that pass-through entity is a partnership, an S corporation, limited liability company, can also be a sole proprietor. And to distinguish pass-throughs and their taxation from C corporations, this is not, there's no C corporation issue within this deduction. So the reason why I'm pointing that out is because the workarounds that have been sort of blessed by the IRS, the first was enacted very shortly after the SALT deduction cap was put into law federally. That was in Connecticut. So the way that that law has sort of sparked other states to create similar workarounds, the way that that law is enacted and how it functions is that there is a state tax that's paid at the entity level. So that's by the pass-through. The pass-through can deduct that income federally on the pass-through's income, and they can deduct the full amount of the SALT of the state and local taxes paid. And the IRS has made it clear that the deduction cap, that $10,000, does not apply to businesses. It only applies to individuals. So then when the individual members of the pass-through are having their federal tax liability calculated, that amount that's been reduced by the full property taxes or other taxes paid passes through to the members. So it's reducing the members' federal tax liability. Pass-throughs also pass on their state tax to individual members. And so the way these other states have created their workaround is by imposing a new state tax at the entity level, and then the state tax is passed on to the individual members who can then claim a credit in the state. So in Connecticut, I believe that's the only state that has a mandatory tax on the entities. Other states have created elective taxes, so the entity pays and then the tax is passed on to its members, and then they are able to claim some sort of tax benefits. Typically a credit could also be an exclusion. And most, and I don't have the exact numbers, but I believe that the majority of these states are imposing a partial credit or deduction. It's not a full credit for the amount of the tax that was imposed at the state level.
This bill, sorry.
Yes, so I was just about to pause because I just talked for several minutes.
Okay, so the strategy doesn't involve really anything about their property tax or taxes paid in their home, the individual. It's just that if your liability flows through as an LLC, for instance, the LLC can then handle income in such a way that you end up with a credit that in essence is going to offset what you experience personally because of the loss of a deduction.
Correct. And yes, I remember that discussion from last year. There was confusion around, are you claiming your property taxes as a credit? No, it's the amount of this new sort of entity level state tax that's being paid by the pass-through. That's where the credit is flowing.
But if the entity pays, the entity is me and my two partners. If they pay a new tax, so I pay $1,000 to the state, and then I get to deduct $1,000 from my federal taxes, how am I ahead?
So then maybe if you used a bigger number, so maybe it's 20,000. So you're well above that $10,000 cap federally. That you're reducing the taxable income federally, and then that's flowing through to the individuals who, there's also the state tax. There's both the federal benefit, and then there's also the state tax that are flowing through to the individual partners.
I need a graph. I'm just having trouble visualizing this. If the entity is paying the state.
Yes, but it ends up being the liability of the individuals. So you're already
Okay,
an entity
but the money
tax.
has gone to the state tax department.
Correct.
I then claim that as a credit on my federal,
Nope, on the state. The
on the
state then gets the credit.
state. Okay, so I get the money back.
So the entity would be able to claim the deduction of the amount of tax paid. So that would have been
I
that
could
20,000 would
claim
reduce their
the,
taxable income.
So it would,
This
I'd
is
have to
federal
pay $20,000 to the state, and then I get to claim, because this isn't a SALT tax, this, I could then get back from this, I need a graph.
Sure.
Reduces income.
But there's-
State taxes.
I reduce my income. I gotta see a graph. I'm just having trouble
I've
visualizing.
been making lots of flow charts.
It's just the most artificial thing I think I've seen for adjusting something.
Yeah, I mean, I can't see how if I pay the state in order to get a federal tax credit.
Good, so it's a federal deduction. There are two different tracks. You've got your federal deductions, that's reducing your federal tax liability because you paid a state tax and then you got a state tax credit. It's not usually.
Okay, so I
for
deduct
100%.
$10,000 from my federal. And then the state gives, but I paid the state 20. The state gives me a $10,000 credit
So
towards my state taxes.
in the S-45 contract, it's 90% of the tax paid, so it's not a dollar.
Oh, so, all right, so I'm gonna lose something,
Right.
but, and that's where the state makes money.
So I don't want to steal Commissioner Bolio's thunder, but his slide deck, when he presents, he does have a pretty good graph, which
Okay.
walks through some specific
Well,
numbers.
he's coming in at 3:30, so, all right, I'll take this one on faith. Okay,
I moved to the next slide because you mentioned it's artificial. As I said, there were other workarounds that were found to be invalid, that the Treasury issued different rulings saying this is not a valid way to structure a charitable contribution. For example, that was the primary one that other states were trying and that was.
29 states have enacted this.
This, however, was in 2020, there was a notice saying that these workarounds are allowable, entity level taxes paid are deductible. They have not, the Treasury Department has not issued official regulations, so it's still just based on this notice. But that was an intent to issue
they're not
regulations.
coming after us.
No, and there are many states that have, more than half at this point that have enacted this type of workaround.
Yeah, I think last year it was lower than that.
Yes, so, yes, so that's the next slide. Since 2018, 29 states and New York City have enacted these type of workarounds, and just last year, 11 new states and New York City did enact one. Connecticut was the first state. It is mandatory. I don't believe there's any other state that is mandatory. I think that there was perhaps reasoning in Connecticut that would have helped it pass muster with the IRS, but that doesn't seem to be a requirement.
Connecticut also lost a lot of money with hedge fund and other regulations, so they might need that little margin at the top.
And most states are providing a credit. It's a percentage, not a full 100% of the taxes paid by the entity. And last session was the first proposal, and now you also have S-45 this session.
I don't know if the percentage was part of the last discussion, but I think that's an important piece to highlight now, is that makes this revenue neutral. So Vermont actually will gain a little bit and definitely will not lose any money. If anything, that this will take money away from the federal government's coffers, but it will be revenue neutral, if not positive by 500,000, depending on what that 90% threshold is.
Yes, and I would defer you to JFO for that analysis.
Okay, yeah. All right.
What's the 90%?
Because last,
Yes,
no,
that's the
I don't remember, or maybe by the time it got down,
Change.
yeah, but I don't know if it, I don't remember
The
here.
last couple of days, right?
Yeah. Okay.
Can you remind me why we didn't do this last spring? Did we just run out of time?
It got stuck in a hole. When it came here, the tax commissioner just said, well, you know, that's something other states are doing, but he hadn't,
There was no plan,
Yeah.
basically, and they hadn't, and the clock did run out.
Yeah.
In terms of the time for them to really think through and come up with a mechanism to make sure and that they were comfortable with it.
yeah, it got put on a couple of economic development bills that weren't going through the tax committee in the other body, and I believe it got taken out. I'm not sure under what terms?
Will this be applied to tax obligations from 2022? No, I mean, won't pass probably till after April 15th unless it's a hurry up mode, right? Or,
I will have to check, but I'm almost certain that the length, can I stop sharing my screen just to confirm? It should be 2023. I'm just gonna look at the bill.
There are people filing the 2022 taxes.
Already.
Correct, because that would probably be administratively challenging. So yes, so the section 4 of the bill S54 applies the tax inhabit structure retroactively to the start of this year, so it'll be for next year's filing. That's a good point.
So, yeah. We try not to change tax laws, but
I could have imagined some people being motivated enough to file on the return. That's- Okay, thanks.
I think we assume most of these people have accountants. We probably have the paperwork waiting to go, but you usually start, well, it'll start July 1st for next year, right?
January 1st, follow the
Jan-
full taxable year,
That's right,
not property, you're thinking.
not property,
tax.
yes, so it would be this year, all right.
To Senator Brady's question, what I understood from the conversations, I actually met with Senator Sorokin as well a few weeks ago about this, and that the last couple of days, and maybe Senator Brock remembers this more, is when that 90% piece got injected into the conversation to make this revenue neutral, and that's where just time is just, we're out of time. It was too hectic. It made sense, but to
Yeah.
communicate that to all the parties was.
And it hadn't been through any of the tax committees. I think things got slightly territorial.
And I could look into other states, I don't have that easily, I could find that if you'd like, just on what their percentage is for. There are different, I think some are 80% of the full credit, for example.
Okay. Okay.
Would you like me to walk through the bill as well?
Yeah, we're still waiting for the tax commissioner. Is he coming over or zooming?
His assistant will be sharing the screen. I think he'll be here in person.
He'll be here in person, okay. He usually comes in person. All right, we can do a quick walkthrough.
If you are interested in seeing the background and all of the legal sites, the first section of S45 does lay out the findings and purpose, which states pretty much what was in that presentation, talking about the IRS approving these types of workarounds following the Tax Cuts and Jobs Act. Also to note again, this deduction cap at the moment is only in effect through the 2025 taxable year. So there have been different proposals to repeal it. It doesn't appear that any are currently moving federally. There's also a finding about the 29 states that have since enacted this workaround. So moving on to page 3, and I assume the committee is following along. I could also share with the scrolling when I'm ready. That'll make you all a little nauseous.
The committee
It's okay.
is on the webpage, or Abby can share it.
I can put it up there. I just move
It's
around.
on the table.
Oh, there's also a printout on the table.
Okay, is there a reason that it, other than influence or something, that it was for pass-through corporations? I mean, is that like, that it didn't extend to other,
I think the logic is so that the individuals who are paying
Yeah.
who can't access above the $10,000 because of the cap, that's the way to pass that on to individuals. Corporations are not subject to the cap. Pass-through businesses are not subject to the cap.
And just basic wage earners are.
Yes.
Yeah.
out left in the cold?
Yes.
Yeah.
Are we working from the handout of the
And the bill
bill
language,
itself?
S45.
Okay. So let's see if we can get through this. We've got about 5 minutes.
Just to get into the second section on page 3 is the definition section. So this sort of clears out who is eligible, who is not. Just point out a few ways that this was structured. Member means a member of an LLC, of different types of partnerships, or a shareholder of an LLC. That this was a limitation that was in the last one of the versions last year, where the member has to be a natural person, so it cannot be a C corporation. So again, it only goes just to Senator Bray's point, if this can only be taken by individuals. That's sort of the end goal, is for the pass through to reach individuals,
Natural person.
as opposed to a legal person.
Which is a corporation, is a legal person.
There is, moving on to page 4, unless there are questions, I'd like to just let you all have a chance to read through. Page 4 lays out the election and how that functions. So again, this is an elective tax. There could be circumstances where different partners or members of a pass-through would not want to use this elective tax.
Okay, so they can determine they want to pay the state.
And
I think this is the first time we've ever passed a tax that people can decide if they want to pay it. And that's,
The lottery,
well, it's not a tax.
it's money that people get from the government.
Yeah, but they might win something. But I mean, that is just an unusual.
That said, in this version, other states do it differently. If the pass-through elects, it applies to all of the members. Other states allow it to be more complicated and for different members.
I'm trying to understand why an entity would elect not to. If, for example, you have a pass-through entity that has both natural and corporate members, would that be a reason not to?
They would not be eligible because of the.
Even if one of them and the others were natural persons. So why then would an entity elect not to participate? Just out of curiosity.
I know that there are sort of more based on the individual's tax liability, but I don't have an example right at my fingertips, but I can get back to you with
Just
some examples.
curious.
I've seen that in the discussions.
The Patriots are like paying taxes.
I don't know, maybe the commissioner will be able to answer that.
Senator Bray.
Just the very last line, line 21 of page 4. Why does it come to it the same highest marginal tax rate?
And so this is the tax rate that would apply, to choose one tax rate that would apply. And I don't know if there's necessarily a policy reason that could be different, a different tax rate, but it's to have one single tax rate apply. For example, in withholding, estimated payments, other pass-through taxation, there's, when you have non-resident members, there's a specific tax rate that applies. That certainly could be a different rate.
So this is exactly what it is. It's a way to allow certain taxpayers to deduct what they used to be able to deduct, but now can't from their federal income tax. And they can choose to do this or not. And there is one tax rate. This is a take it or leave it. This is what we're going to give.
And so the tax applies to each member's share of their proceeds from the distributed proceeds from the entity. And then I did just want to point out that, again, the election applies to the whole entity, but consent must be given either by each member so that they can all agree this is beneficial, or someone with authority to make that decision, such as an officer, manager, or another member was able to represent that they have the authority to make the election. Just so it's not any one member can say, yes, let's do this. But
Somebody has to have legal authority within the LLC, and that's spelled out somewhere in paperwork.
Yes, so it would be under the entity's organizational documents, so their articles of incorporation or other agreement, so just for partnerships. And at least one member of the entity has to be liable for income tax in Vermont. So it couldn't be a pass-through that has no connection to Vermont.
Okay, so if we have a pass-through on the Vermont-New Hampshire border, and there's 3 members, one's in Vermont, two's in New Hampshire. This would still work for them?
So that maybe is a good example of a way that some entities would not. That's exactly that situation where you have some non-residents and some residents. So the non-residents wouldn't, other than paying the tax and getting the credit on 90% of it, they would have no liability cure that it would help with.
So, all right.
Although, sorry, I was saying liability. It is a refundable credit, but it might not be to their advantage to elect to pay that in Vermont. Not sure how much detail you want to get into how the election is filed. It's annual. They can revoke it as well. But the revocation of the election has to happen before filing the return. And then there's provision for making payment of the tax. And then, sorry. I was down on.
I'm on page 5.
Yes, sorry, I'm trying to go through
A
this.
member of a past due entity shall not be liable for the individual income tax imposed under.
Yes, so in circumstances where there's a member that's a non-resident and their only Vermont income in the tax year is from the past year, so that's exactly your example
Okay.
there.
That's
They
what
would
that
not
is,
be
all right.
subject to personal income tax.
I don't see any sunset on this. Do we need sunset or does it become unattractive
Well,
naturally once the federal code
The
changes?
Fed goes away in 25.
That's correct. So there is
So
no
this is
sunset on
2
this. This is
years?
permanent. You could continue to use the credit and refund, or not refund, sorry, the tax and credit structure.
So after 25, is it conceivable you get the full credit of the state obligations you paid? And you could also file this? I mean,
Correct. Deduction, it's a deduction.
But in 25, when I.
26, starting at
26,
Yeah.
all right. When I file for my taxes, I can take the full $20,000 deduction that I paid in state and local tax. Why would this system need to be in place then, other than that we're making money?
That's more of a policy decision.
I mean, why would any,
So,
seems like a bonus of sorts at that point.
We sunset things all the time, right? So
oh, yeah. I mean, this is meant to be a workaround for a federal law. The federal law is going to end in tax year 25 or 26.
so it ends at the end of 25, so you
Okay.
wouldn't have the impact till you're filing in 27.
Oh, Okay, so we could end this in 26 and then when you file, yeah, because otherwise it's just making things more confused than they already are.
Seems like they were creating inequities beyond just compensating for the federal tax code change. Anyway, so that seems like it'd be worth considering sunsetting.
Yeah, I would think.
I'm just coming back to that notion of an entity electing not to participate and looking at the section of non-residents so that there's applicability to taxes paid to other states who have similar taxes. I would think that you would not elect if you had no tax paid to another state because there's nothing to collect back. On the other hand, if you paid a state that had a higher tax than 90%,
It's the credit this percent.
Yeah. would that have an impact if that tax rate was higher? I mean, because if you're only going to get back 90% of what you paid in, you wouldn't want to do it. If you had the opportunity to get back more than 90%, when it's 90% of what you paid, even if it goes to another state that has a higher tax rate.
So there are two credits actually, so I'm glad you got to that because I haven't gotten into that level of detail yet. So there's the credit that is 90% of the entity level tax paid, that's the individual's portion of that tax paid. And on top of that, there is this credit for taxes paid to other states. There are two different credits. And the credit paid to other states and provinces is only for residents. That only is available to Vermont residents. So if you're paying, perhaps you have example of having a pass-through that is electing in two different states to pay the tax, the state entity level tax, and then taking the credit in each different state. If you're paying more in another state, then you can, and you're a Vermont resident, you can claim the credit for taxes paid in other states. So that sort of evens the, so you're not being taxed in the same way that personal income tax allows that for Vermont residents already, to sort of alleviate being taxed in two different states on the same income.
Probably need business tax account to come in.
It might be helpful to have examples and seeing.
I think this is
dollar
about
amounts
the
of
8th
this.
grade final tax. So we need to,
The ninth grade.
definitely not grade or higher, find out how to game the system, but, okay. If we sunset it in 26, you can't get in too much trouble.
I don't want to steal Commissioner Bolio's thunder again, but I know that in his slides, he's going to speak a little specific to this issue about Vermont resident owners from out-of-state PTEs. And I think I already met with him and he explained that pretty well. So
Have we heard from the commission? Has he mentioned we have
He
not?
was in another committee till 3:30.
Uh-huh, I'll bet you it's ways and
Yeah, his
means.
presenter is, well, she knows.
All right. So, okay, that's, Mariko is his scheduler, who sends out all the emails. Okay, so Abby, we're through this, right?
Yes, unless you'd like me to go into more detail about the other states, but it sounds like the commissioner has that.
I think he's
With pictures.
probably gonna go through that. So we can stand at ease. I'm not gonna let you out until the commissioner gets here.
I'm gaining weight by standing room.
I know. I'm hoping this week, I think it may be on tomorrow, it's on this week, that we can do that individual small group market and just get it out of here. We extend that separation for 3 years as long as the federal tax credits are there. Everybody loves it. So I think that one I'd like to just send along. And
yeah, I fully support that. That makes a lot of sense. And what was going through my mind as a new person to this committee is, in a way, that merged markets is we're adapting our state tax code to maximize the benefit for a subset of our insurance insured. And I saw corollaries with this too. Is this a comparable in some context that we're adapting our state tax code to maximize?
it's not tax code. This is insurance markets, and it's trying to keep the cost of health insurance affordable.
Okay.
And if without the federal subsidies, the cost in the individual market left on its own, at least according to the healthcare advocate and anybody you want to talk to in the public, is, unless you're very wealthy, it's unaffordable. So we merge them with the small group market, but that, because they're a high risk in the individual, raises the cost of the small group, which is your small businesses. And that makes it harder for them to pay. So it's just trying to keep the cost of health insurance as low as we possibly can. The feds put these added subsidies in. Maybe they'll see the light and keep them. And
It's not tax code, but
no, it's insurance markets, but they are subsidizing one insurance market. I assume because they recognize that probably the smallest of the groups is just because it's so small. If I were healthy and could work, I'd be in one of the other groups. Okay.
I will be in the room if you have other questions for me.
Well, maybe, yeah. Austin, do you want to
Sure.
testify?
Yeah, I can jump in.
While we're waiting for the commissioner?
I'm sitting here with a doodle on a notepad, something that might be helpful, but I don't know.
Oh, good.
Uh,
That's about what I was
Spaghetti
saying.
diagram.
Yeah. And,
For the record, Austin Davis, Director of Government Affairs with the Lake Champlain Chamber.
and the state chamber had a conflict, and Megan couldn't be with us this afternoon, so you were carrying the burden.
Yes, and the Lake Chamber's been pushing this for some time. I looked back in my inbox actually earlier this year, and my earliest email on this to Ways and Means was back in 2019 when Connecticut actually found this workaround. So I can get into that a little bit more, but thank you for this opportunity to sit down and discuss to you what is effectively free money. This is a very unique opportunity here to actually, in a state legislative capacity, affect federal tax code and not just have a net neutral revenue impact, actually bring revenue into the state. And I think in any context, our goal generally is to keep money from leaving the state and to draw as much federal funding as we can. So this is no different than many other situations we find ourselves in. It's just a lot more complicated. And it's unfortunate that it's that complicated. However, that's what happens when you have someone find a loophole and try to create it in statute, and then the IRS end up blessing that. But you know, Vermont's
Let's hear
one of the
about the IRS blessing loopholes, Commissioner. Probably a good time. Let's see.
That's actually how we summon him. We just say IRS blessing loopholes. Commissioner
That's
Boley.
like saying put a lien on the property and Chris D'Elia appears.
Yes, it's effectively the same. So Vermont's one of the few states that's not implemented the salt tax cap workaround. You know, we're kind of needlessly sending dollars out of state and putting our businesses at a competitive disadvantage. At this point, we're about 29 states that have implemented this out of the 41 that could. I'm reminded that there's 9 states without any kind of income tax. So, you know, this is this very unique opportunity. I sent along to you folks earlier today, it's posted on a committee website, a letter from 28 different organizations that work on behalf of Vermont businesses. They include the Lake Champlain Chamber, the Vermont Society of Certified Public Accountants, Vermont Businesses for Social Responsibility, the Vermont Chamber of Commerce, Vermont Professional Color Network, Renewable Energy Vermont, Vermont Association of Wedding Professionals, Vermont Builders and Remodelers Association, Vermont Technical Alliance, Vermont Retail and Grocers Association, almost done, Vermont Association of General Contractors, Vermont Lodging Association, National Federation of Independent Businesses, Heating and Cooling Contractors Vermont, Vermont Fuel Dealers, Vermont Vehicle and Automotive Distributors Association, as well as all of the regional development corporations. You know, as I said, we really do see this as a unique opportunity to nullify what we like to kind of some of us like to call the blue tax. As a reminder, the cap on the state and local tax deductions really was a punitive measure out of the 2017 Tax Cuts and Jobs Act, meant to hurt blue states. Blue states are generally higher tax states. And because of that, we benefit the most from the state and local cap deduction. And that's why we see a lot of partisan fighting in DC about the state and local tax deduction at a regular basis. So, you know, that's just something to consider as well. Other than that, I think, you know, Commissioner Bolio and others could speak better to the technical. I could work on a better diagram to show how it works. I know it's complicated, and I think that's just an unfortunate portion of how it came about. You know, it was a concerted effort by blue states to try to find a way to work around a punitive measure, and this is what you get. You can take any questions if folks want, but, and I think the latest JFO analysis, if I'm correct, was that, it could save Vermonters up to from somewhere between 10 and $20 million. And just by virtue of that, because it's a 90% credit, there's no way around. It will have a revenue positive impact of at least, if that were in that range, $500,000 to the city.
I need piece of software for the computer system. Okay, any questions? Right, thank you. Commissioner, welcome. First time you've
In dollars.
been here.
but I came in-
I can do what's-
Euros,
That's
yeah.
right.
Many exchanges.
So many people pop on the screen and then pop in.
Oh, I'm happy to be over
So, yes.
there. I have,
We heard
Marty,
you
go
had a
here.
wonderful diagram.
well, I hope so. I mean, I was just in House Ways and Means walking through this, and my takeaway was, it's complicated. So,
Yeah, I
We're gonna
was,
work
I
through it.
was looking for a whiteboard with lines, but
I do have a handout that is one of my slides blown up, so I might start by handing that around.
This is the one we will preview.
Oh, perfect. I
Waiting
gave
for
myself a copy as well, so that's great. Okay, and forgive me if I repeat some of what you heard from the other witnesses, but I'll just try to give you the high level overview, right? So, Maude, if you could just start on maybe the slide that has the proposal and current law, revenue impact, maybe one forward.
You can call this.
Perfect, thank you. So, I mean, this is like a really interesting and unique opportunity for the state. I have been calling this, this being a pass-through entity tax and the SALT cap workaround. I've been calling it both the closest thing I've ever seen to a free lunch in state tax policy. And I've also been calling it the Wayfair of the 2020s because every state is doing it. So the background here, which again, apologies if you've already heard that from the other witnesses, but in 2017, the federal government passed the Tax Cuts and Jobs Act, which limited the amount of state and local taxes that could be deducted on federal personal income taxes to $10,000. States love the SALT deduction because it means the federal government is subsidizing a portion of a state's taxing capacity, right? And any dollar of state taxes paid, if somebody can take the SALT deduction, means that they are not bearing the full cost of that dollar in state taxes. So as you can imagine, because states loved the SALT deduction, they did not love the SALT deduction cap, and they tried to quickly work around it. One of the ones that got the most press is that a number of states wondered if perhaps their state taxes could be considered charitable contributions that would be deducted. The IRS quickly said, no, they cannot. And states went back to the drawing board. And this was another mechanism that states had created. And people were not sure how it would shake out until late 2020, I believe November of 2020, the IRS issued notice 2020-74 that said, yeah, the structure is okay. And this structure is states creating a pass-through entity tax so that owners of pass-through entities can pay their state taxes for that entity at the entity level where there is no cap on those state and local taxes paid, and then issue a credit for personal income taxes paid so that people who are taking advantage of this are not double taxed. I would note before I jump into the meat and potatoes of my handout that this structure actually does exist in current Vermont law, but only for non-resident owners of Vermont pass-throughs, which is an interesting inequity. It's called composite filing. It does not exist for the purpose of functioning as a SALT cap workaround, but it happens to, right? And that has been on the books for many years. So current law has an inequity where we are favoring non-resident pass-through owners over resident pass-through owners. And as I suspect you've heard by now, but the Joint Fiscal Office did an issue brief on this, and they estimated that there is a potential savings of $10 to $20 million of federal taxes for Vermont pass-through entity owners with this. And depending on how you structure the credit, and I'll walk through that here in a moment, you can actually guarantee that this proposal could be revenue positive for the state. So if it works for you, Madam Chair, I'll move to my handout, which is the next slide, and just work through one of these examples. So a reminder, normally a pass-through entity like a partnership or an S corp will get its distributions through a federal K-1. That's the document that people are reporting on their personal income taxes, their pass-through income from their entities. So in this case, starting with the top left box, I'm trying to make just a simple example. So $1 million of S corp income with an S corp that has one shareholder, one owner. Under current law, there's no pass-through entity tax paid, right? So their federal K-1 distribution is that $1 million. They have a SALT deduction cap of $10,000. So even though they pay close to $80,000 in state taxes, under current law, they can only deduct $10,000 of that when they go to file their personal income taxes. They also pay about $300,000 in federal taxes if they're married, filing joint, and this is the only income for the taxpayer. In the top right is an iteration of this that I used just to show the example of the initial mechanism of the workaround. So same $1 million of S corp income. Now that would have a $76,000 pass-through entity tax paid. That's what's outlined in S45, because that is the current composite rate. So again, looking at this as parity with composite filing. So that's $76,000 of pass-through entity tax paid, which is fully deductible at the entity level federally. So on the 1120S, they can deduct all $76,000 of that, which means their federal K-1 distribution becomes $924,000. And that is the mechanism for the workaround, right? The $10,000 cap is still in place on personal income taxes, but they have worked around it by lowering their federal K-1 distribution amount. So with a $924,000 federal K-1 distribution, they're now paying $275,000 in federal taxes, a savings of about $25,000. But here's the rub, right? Under this mechanism, if we were to give them a dollar for dollar credit for their pass-through entity taxes paid, they would only pay $73,000 in Vermont taxes because that reduction in the federal K-1 also flows through to Vermont, right? So that would be a problem, right? There's a fiscal impact to that. We'd have to budget for it. We'd have to debate it. I have a solution. The solution is you don't offer a dollar for dollar credit for pass-through entity taxes paid, and that's what's outlined in the yellow bar in the middle. So if you look at the lower left box in the white, that walks through the same example with that 90% credit. So same $1 million in S corp income, same $76,000 in pass-through entity tax, same $924,000 in federal K-1 distribution, but the taxpayer only gets a credit for $68,400 on their personal income taxes. So they still get the $25,000 in federal savings. The credit scaling does not impact the federal return at all. But they actually now pay about $81,000 in state taxes, about $1,000 more than they paid under current law. But they're still going to do it because they're saving $25,000 at the federal level. So in the lower right box, it really explains how this works, right? So Vermont's highest marginal income tax rate is 8.75%, right? So for every dollar of pass-through entity tax paid that lowers a federal K-1 distribution by $1, they would gain 8.75 cents in reduced state personal income taxes. But they lose a dime because of the 90% credit that they're getting from their pass-through entity taxes. And so the state actually nets the difference between those two. So for every dollar of pass-through entity tax paid, the state will get 1.25 cents. The mathematical relationship turns out that it's about 3%, between 3 and 3.5% of the federal savings is the revenue up to the state with a 90% credit. And maybe implied, but just to say it explicitly, what this relationship means is that if the credit, for instance, were 91.25, right, 100 minus 8.75 would be exactly revenue neutral, right? So as you lower the credit a little bit, you get some revenue up as well for the state. So that's where the free lunch is coming in, right? It's that there is a tax cut out there, federal tax cut for a portion of Vermont business owners that actually nets the state, in this model with a 90% credit, $500,000 for doing so. And so you can see why it's been attractive for states who like the SALT deduction to be able to implement this workaround essentially for free. And if we move to the next slide, you'll see a map of the US and who has taken on this policy. So blue means there's no state income tax, and you can't do this if you don't have a state personal income tax. Green are the states that have passed this, and yellow are the states that have not. So out of the 41 states that have a state income tax, 29 have passed this, most of which has come after the IRS issued the notice saying this was okay. So that's why I've been calling it the Wayfair of the 2020s, right? The IRS issued that notice, and virtually every state that could has passed this at this point. And even in those yellow states that haven't passed it, like there's activity on this. I believe maybe only Maine and Delaware have not had at least a bill introduced on this. And each year there's more and more states that are coming into the fold on this. So I've never seen anything like it in state tax policy. It's a really unique opportunity, and I'm appreciative of folks putting forward S45, including Senators Chittenden, Brock, and Rob Instead.
Okay.
Oh, I'm so sorry. I actually have, if I could just really quickly, Madam Chair, I just forgotten this. Could you move to the next slide, please, Maud? There's a few elements of the bill, because you know I like to talk about the administration and operational elements as well. There's a few things in this bill I really like, and it makes it easier for us to administer. The first is that it's elective. So this is only businesses that this makes sense to do will do it, which should lower our volume, which will help. The second is that it's only allowed for pass-through entities that have only individual shareholders. So if you have a C Corp owner or it's a multi-tier pass-through, no dice. You've got to go to the place where it's all going to individuals, and then you can do it. Again, not having to track this through C Corps and multi-tier is a big win for us. And then all owners must elect the same treatment. I'm a big fan of that. Again, looking at how composite filing worked in the past, it used to be that individual owners of businesses could pick and choose if they wanted to be composite, and it was really hard to track, and it made it really difficult for us to get the money where it needed to go and have high service levels for taxpayers. For many years, it's now been all or nothing on composite, and that has greatly improved their service levels, and I think taxpayers are happy with it, so I support that here as well. And then the last point I would make is, it may feel like a small one, but it's an interesting one to me, that current law not only prevents resident owners of in-state pass-throughs from taking advantage of this, it also prevents resident owners from pass-throughs in other states who have this structure from taking advantage of it. So for instance, both New York and Massachusetts have a pass-through entity tax. If you are a Vermonter who owns a pass-through entity in those states, you cannot take advantage of their pass-through entity tax and salt cap workaround for that bill because of the way other states' credits work in Vermont. So if you earn income outside of Vermont and you're a Vermont resident, you pay tax to that other state and you get an other state's credit to Vermont. But Vermont does not recognize those pass-through entity taxes paid as personal income taxes for the purpose of another state's credit. So they can't take advantage of this in those other states because they'll get double taxed. So this bill also addresses that and clarifies that the other state's credit can also be issued on pass-through entity taxes paid in Vermont if there were pass-through entity taxes paid in another state. So it's helping a lot of different areas of the tax code that are currently disadvantaging resident business owners, all while making a big tax cut for those business owners without impacting state revenues at all. Actually, I should say impacting state revenues positively.
Okay.
I'm happy to. I've been in the weeds on this. Welcome to the nerdy portion of the show.
Okay, I was doing fine until you got to composites. I think we did something with composites a few years ago, and I think I presented it, no one asked questions.
And I'm happy to just give a brief overview if that's useful, Madam Chair.
It might be.
Yeah, so if you are today a non-resident owner of a Vermont pass-through, you have to pay what's called non-resident withholding. And really that's a mechanism because you don't have maybe a big tie in Vermont. We want to make sure we get that income tax money. So you have to pay the non-resident withholding. For ease of taxpayer filing and administrative ease for the department, there's also something called composite filing, which says, okay, instead of paying non-resident withholding and then having those payments and that tax liability flow through to the individual level, you can just pay it all and handle it all at the entity level in a composite filing. And again, while that structure doesn't exist for the purpose of doing this workaround, it's the exact same mechanism, right? It's an entity level tax where they're fully deductible at the federal level. And it actually absolves the non-resident owners from even a filing requirement in Vermont if they don't have any other income. Again, that's for the ease of administration piece and ease of filing. So that exists today. It's a fine program for what it does. That's not necessarily this purpose. So we have no reason to change it. But doing nothing on this perpetuates that inequity for resident pass-through entity owners versus non-resident pass-through entity owners.
Okay. Thought has been raised that since the federal
Tax code expires. in
tax code
2025.
expires in 2026, that we might sunset this? Is there a reason why, if this is not taxable, if you can continue to deduct it on your federal taxes, then of course, they might all just decide to extend that, but why would, except we'd all get angry at them if they did,
It hasn't stopped them before.
yeah.
We've been angry at Congress before
Well,
in this
I
committee.
know. Apparently, a lot of us didn't like this one.
I mean,
I know, is there a reason not to sunset it in?
I do not believe there's a reason for this structure to exist if the SALT cap does not exist. So if the feds tomorrow said, no more SALT cap, that's the end of this, right? So what I might recommend is if the legislature is interested in sunsetting it, and I actually see some reasons to do it this way, tie it to the federal cap going
That's
away,
what
right? So
I
that
was-
if they extend it, then it extends here. But
And we won't be going through the whole insurance market, do it for 1 year, tie it to the federal action. If the SALT goes away, then this workaround goes away.
yeah, frankly, I appreciate that from my chair as a tax administrator as well, because, and I hope I don't put my foot in my mouth here, but I have not been able to understand a reason why this structure would have to exist if the SALT cap didn't exist. And so then I do have a minor worry that if it existed separately, you'd have a certain share of taxpayers who don't realize it, or they just aren't sure what they're doing, and then they, I've got to have it on the forms, but it doesn't serve a purpose. So I am totally fine with, but my preference would be that conditional time,
Yeah.
right? So that, because I don't know, the feds might extend it, and then I don't want to have to come back.
And that just means we have to go through and, yeah, okay.
What if they change it? Not extend it, but just change it.
I mean,
Extend it in some other form.
If there's a cap, I guess I haven't thought of every possible permutation, but let's say they just raise the cap to 15 or 20, right? There's still value to this with the exact, all the math would work out the same. It would just be a smaller share of people who would take it. So barring like a huge cap where we don't think the juice is worth the squeeze anymore, I don't know if you have to make any changes if they just change the cap. I guess if they wholesale change the structure, but I don't know what that would look like.
No, if they change it, there'll be legislators
Well,
and tax commissioners in the future.
Yeah, I mean, the most likely thing is the laws it states now is it goes away. And so when it goes away, this goes away. If they start playing with it, then the legislature at that time can say, okay, they've changed the rules, we'll change the rules.
Yeah, totally fair.
Okay. All right, Senator Chittenden, I am sure, since I'm going to assign you to report this, if it gets out of here, that you understand the diagram.
I think I know enough to be dangerous, so I'll
That's
do more.
what I'm starting to feel about myself.
I'm completely safe.
You're completely safe, all right.
I'll do my
But, okay, any other questions for the tax commissioner?
great presentation. I love this.
Sorry, say
A
that.
great presentation. I love
Oh,
this.
cheers, thank you.
It is as close to understandable as I think this.
And look, I work in this space, right? And I have for years, like, the first time I walked through this, it was like, it was heavy, right? Just like understanding the mechanism and making sure, and then we hit like the mathematical epiphanies last year. So it's been a journey, but it's been a fun one for a tax nerd.
So good, okay. Yeah, this has come a long way from a year ago, and then it went through economic development, and it kept working its way through, and I think this is ready for prime time, so it's probably gonna get.
I agree.
Okay, and who says anyone has to understand the tax code? That's why there are accountants.
And I understand it, and we stand by to help at my department.
Okay, your department, when they were in, we asked them to take a look at one of the Consumer Advocates Annual Report recommended that we do some things with the penalty for non-homestead, forgetting to do your homestead disclosure. But also and I looked, I assume it was your department that gave us all a copy of the tax code. I did look at that family income disclosure. Part of what they said is that is very complicated. And there are some things that it costs us more to enforce than we lose if we didn't do it. I'm thinking of rebates and having to go to last year's income, even though we knew one or two people would change drastically and we'd lose some money there. Some way, I think, we've heard stories about anyone that lives in your house. We've already exempted refugees. If you have somebody fleeing domestic violence or, there's all kinds of reasons somebody might stay with you a week or a month, but any thoughts you might share on how we could simplify that, because that has always been a stumbling block. And not now, but
Yeah,
just,
household income is very complicated.
yes, it is.
And when we changed the renter credit a few years ago, we moved away from that, which was one of the big wins. So it's not something that I've dug into in depth recently, but I would agree that the committee is interested in talking about that.
I was told that another chair wouldn't touch it, but that chair isn't there anymore, and I'm got an open mind. Is there a better way we could get a reasonable assessment of household income without making it so complicated that people just say, forget it. I remember my daughter calling up furious one Sunday afternoon saying she just spent all day doing her renter rebate only to find out she didn't qualify. And after that, you just don't even try, and you may very well qualify the next year. So that's just the balance in making sure we get as much as we can, but also making sure people don't lose money because we've made it so complicated that they just say it's not worth it.
Yeah, and I sincerely don't know where that discussion would land. It's a big question and a lot of analysis, but I'm happy to be at the table and try to be helpful how I can be. I think the other body has also expressed an interest in moving the taxpayer advocate's recommendation forward about extending the property tax credit. So we'll see how that goes, but that was a proposal that the department put forward a few times, and we didn't get a bite. So we'll see what happens with that as well. Yeah, there's a hard deadline of October 15th.
Well, yes, there was a time where every year some legislator had a constituent who had a terrible story about, why they missed the deadline. And every year we moved it. And it's, again, consistency helps with things like taxes. And just said, this is it. I think we settled on October 1st, and just was a reluctance just felt like it needed some stability. But that's been a while, and this isn't changing. Well, if we move it and we leave it there, or we do something with the fees.
Yeah, the taxpayer advocate recommended an extension to the following February or March, but with a penalty of like $150.
Yeah.
And I would encourage you to speak with him. I mean,
Yeah,
this is
no,
an
he's
issue.
been in once, and I think we're interested, and these are the kinds of things that end up on our favorite Christmas tree. Select this tax bill, but may well be, you know, I mean, a committee bill or a standalone, since we have that ability
Sure.
to do that this year. Because it might just make it, and if we've already excluded refugees, I can almost guarantee we're gonna have a bill asking to exclude somebody that has, you know, homeless people stay with them, or somebody, you know, or your grandmother stays with them while she's recuperating, and there's just 101 reasons why people have someone that lives with them for a month. They're recovering from surgery. They can't find a home and they're looking, that kind of thing.
Yeah, happy to try to come back and
Okay,
help however I can.
I think that would be good. Okay, any other questions? Well, I'm gonna be merciful and let you all go home and not make you try and figure something else out. They canceled the chairs meeting by noon today, so I was scheduled to have you out in time for chairs. I don't know what happened.
You said something earlier about the possibility of workshop Monday. Is that usually the week before crossover? I just want to plan accordingly to that as much as possible. Is that pretty common?
It is pretty, yeah, I've done committees of conference on Saturdays. It is not uncommon as you get to crossover. Committees of conference at the end of the year, so that usually, yeah, you don't make any plans the first 2 weeks in May or the last week in April. And crossover, we could be here fairly late into the evening, realizing that some people actually have real jobs. It used to be me. Mondays are a last resort because I know that's when people do need to work. But sometimes it's unavoidable. And it may mean you work till 10 o'clock at night.
You get that snazzy license plate.
Sorry.
People treat you like a prince.
Do they?